The market's set to close out a second quarter comeback at a new record high. Now, the idea of a stock picker's market has been around forever. But is it now being replaced by what could be called a theme picker's market? Now, joining us is Tom Lee, the CIO at Fundstrat Global Advisors, alongside independent ETF expert Dave Nadig. And we're all talking about the ETF infrastructure and just how things are developing. Maybe I'll start with you, Tom, about this idea of stock picking versus theme picking. And in this case, you are actually putting together and advising on an ETF product that goes into theme picking that then gets into stock picking. So take us through what your construct is for how to pick themes and stocks.
I would be glad to. It really has its genesis in Fundstrat's approach to research. Our clients, and we now 11 years in running, know we're a thematic-based research firm. So we do long story arcs. We look at population trends. And one of our initial white papers was the idea that there's generational trades to be made. So in the 80s, retail was a boom because women were entering the workforce. And retail stocks were the best performing subsector for 20 years, actually doing almost 160,000% return. And then in the late 90s, 2000s, the big story arc was internet, which is thematic because anybody who made money in retail would have thought the internet was a terrible idea. And so young people bought the internet story arc, and internet stocks have been amazing. And social media was the next wave. So we said, let's think about the themes that drive markets for the next 10 years. And we created a research portfolio called Granny Shots, which identified these 7 important themes. And we update that every year. But that initial theme-based portfolio was labor shortage, because in 2018, we said there was a global labor shortage coming, which equals AI. We said there'd be concerns about cybersecurity that follow that, which was another theme. Energy security was another theme we thought about, because we said, you know what, people are going to want to secure their power supplies. It's actually more important today with AI. And we looked at monetary policy, the business cycle, and then we layered in some tactical and style themes. So these were the basis for what we said, like, this is what drives investing. And then we said, okay, let's find the best stocks in each theme. But if you buy the best stocks in each theme, then you're hanging your hat on a single idea. So we said, let's be like Rick Barry. Let's do a correct physics basketball throw. Underhanded, it's the correct physics way to do it. Doesn't look sexy.
Oh, hence the granny shots.
Correct.
That's the what, because you're talking about the underhanded free throw.
Yeah. And it doesn't look great, but it makes 90% of the shots. So we said a granny shot is one where a stock is tied to 2 themes, because now you're not sort of saying I'm putting it all into AI or all into cybersecurity. And ideally, it's 3 or 4. So our granny shot says a stock to be included has to be at least in 2 themes. And we end up with 35 stocks of the S&P 500, and we're saying the other 465 are good, but these 35 are tied to the 7 most important themes driving the stock market.
All right, so this is a mix of qualitative fundamental analysis and quantitative box checking, if you will.
Correct.
Things that meet certain parameters. When you think about the way, Tom, that you construct the portfolio, you're talking about under 10%, right, of the entire S&P, which is kind of like your target. You're even less, about 7% of the S&P 500. When you look at that, how exactly do you come up with those ideas when they tick those boxes, right? What exactly do you look at in terms of the mix of qualitative and quantitative factors? And then what has that led you down towards? What types of stocks make those 7 themes ticking off at least 2 of those boxes?
Well, the 7 themes really are sort of the most important starting point, because we're like, this got to last for 7 years, and we got to figure out who the winners are. So we find and make a list of stocks tied to those themes. In other words, the strongest names for any single theme. But that is including what we call DQM. So we do a quantitative analysis. We're not buying junky stocks. We want to make sure that they generate earnings and high ROIC. But then the process of ticking off and saying, are you in 2 granny shots, is actually mechanical after that, because we have siloed portfolios of 60, 70 stocks each. And sometimes we wonder, wait, are we going to end up with like 5 granny shots? But we always end up with like 30.
All right.
And we rebalance every quarter, but it is very fortunate. And it starts to pick up some really important themes. Like when we started to think about millennials, then it had us focus on things like Robinhood. And NVIDIA, because of labor shortage, was included since 2019. And Tesla was an AI automation play at the time. So Tesla and NVIDIA are examples of, we told our clients, these are granny shots, don't think about trading them because they're tied to really important story arcs.
All right, Dave, the idea of thematic investing is not new at all. In fact, the ETF market and ecosystem is the perfect place to talk about real-world examples of thematic investing, thematic-based ETFs. Maybe some context here from your side of things about the evolution of thematic investing. Tom has laid out kind of where the rubber meets the road as a sub-advisor for a fund, taking us through the methodology. But maybe you can provide us a little bit more of that kind of story around just how thematic investing has gotten to where it is today and where maybe the origins were.
Yeah, I mean, we started the ETF market with narrow exposures. We think about these big beta exposures that now have all the assets, but ETFs 2 through 16 were targeting small emerging markets countries. And very shortly after that, we had the select sector spiders, which was really the first place thematic investing kind of got packaged up. And those are passive and they don't have an active manager picking and choosing sectors or themes or picking and choosing the stocks. It's just raw GICS classification. The big evolution we've seen very recently, and Tom's very much a part of it, is the move towards active management. Active management, while it's less than 10% of the assets in ETFs, is starting to look at like 30 to 40% of the flows, particularly in things like equity, where over the last 3 months, we've had 40% of the flows into active equity, into funds like Tom's. I think that's a really logical and natural expansion of what we've done in ETFs, especially as it seems like the markets are accelerating. Change happens even faster. And so I think having an active management overlay, both on the stock selection and the thematic part, can make a lot of sense for investors. It's certainly easier for investors to understand. My question to you, Tom, would be, I love your approach. I love the themes that you're in. What would it take for you to recognize that a theme is no longer valid? For instance, you have like loosening financial conditions. I'm not sure that's the word you use. That's one of your thematic sort of silos. At what point would you say, you know what, we were wrong. That theme isn't really what's going to drive markets, or this is exhausted. We've exhausted the potential revenue from this theme. We need to now come up with another bucket for those granny shots.
Yes. Well, that's where Fundstrat's research team comes into play. We have about 20 research analysts, and we know there's expiration dates. I mean, think about biotech in 2016. If that was a granny shot theme that had an expiration date, we never did something with COVID or the GLP-1s. We were thinking about that. Are these 10-year story arcs or are these 1 or 2 year? And we decided these were sort of 1 or 2 year. So to us, there is going to be expiration dates. One thing's very obvious to me is when I look at the wireless industry, I grew up as a wireless analyst, and I covered that industry for 17 years, went from 34 million users to 9 billion. So hyper growth, exponential grower. But those stocks peaked relative to the S&P 1/3 into the cycle. Every sector, infrastructure, handsets, spectrum. So it tells me that at some point, even if we say AI is going to last 20 years or cybersecurity, 1/3 into the cycle of that growth cycle, the stocks are going to become market performers. So we are really aware that relative performance is something we have to be mindful of, and that's where our technical research team is very helpful, Mark Newton, and we do something called super and sleeper granny. So we review the lists every month and think about the top 5, bottom 5. And Tireless Ken is our data scientist, and we're constantly reviewing themes. And stay tuned. We have 7 themes. Maybe we'll go to 8 themes, but we might delete a theme. And for now, I'm comfortable that energy security. These are durable themes. There is one that we're almost positive we're going to launch with, and I mean,
what's it going to be? That's your tease. You got to begs the question. What is it?
Well, we're trying to be, looking ahead 10 years, and there is something very obvious to everyone here. So I don't mind sharing it because the way we express it might be unique. Is that well, there's 2. The first one is what I'd call sovereign security. I think it's now evident to me that the mechanisms are in motion for companies to really fix their supply chains within a sovereign border. And that's a change, right? That's not going to just be 1 or 2 years. And so there's a lot of opportunities there. And the second thing is that, you know, when we first started writing about these themes, this was 7 years ago. So millennials was the engine. You have to remember, 7 years ago, companies like Snapchat had to convince advertisers to focus on millennials. And now they're very mainstream. But that means we need to be focusing on Gen Z and then Gen Alpha. So we might have to evolve our demographic theme to kind of orient towards the younger cohorts. And so these are important adjustments that we're playing with, but when we turn it on, it may not be for a couple years, but I'm kind of sharing our thought process.
It's interesting too, Dave. The thought process that Tom just shared took us through the real world evolution of how you evolve or actively manage, if you will, an investment strategy, speaking to the point about actively managed ETFs taking more and more market share. The active management philosophy, is that one that can get as much traction 5, 7, 10 years from now as the passive management side or indexing side of things had in that first 5, 10 years of the ETF life existence in and of itself?
I think we'll get some traction. I think it's very hard to compete against 3 basis point beta as the core of a portfolio. And I think most long-term investors are going to continue to have a passive core. Where active has gotten a lot of traction has been in the edges. I would call this a little bit on the edge. You're probably not going to take the entirety of your portfolio and put it in Tom's fund. No offense, Tom. I think most people will be thinking of this as an explore strategy against their core, which is going to be cheap beta. And I think that's true whether it's fixed income, whether it's emerging markets, whether it's country allocation, whether it's currencies and commodities and cryptocurrencies. I think people will be looking for what is the base case cheap way to get exposure, and are there opportunities to engage an active manager either for raw outperformance or just for better positioning on a risk reward spectrum. That's the smart way, I think, to think about active management, and it does seem to be how most of the market is adopting it.
All right, so the active management portion is also about actively seeking alpha, right? To find that outperformance, you have a core and you're trying to explore certain places where you can get some of that added edge outperformance.